A driveway sits empty on a sunny afternoon. The mailbox flag is up. Inside waits a single envelope. Policy non-renewal. Effective in 60 days. No prior claims. No visible damage. The house looks unchanged. Lawn trimmed. Windows clean. Neighborhood peaceful. But the coverage is gone. Options narrow. Costs climb. This is happening right now in places that still feel secure. This is where cities recalibrate long before prices drop or streets empty. Right now, this just looks like an insurance problem. It isn't. Because when insurance disappears, mortgages stop working. And when mortgages stop working, prices don't fall. They freeze. Then they crack. I'll come back to that. Stay with me, because by the end of this, you'll see why this pattern decides which neighborhoods hold value and which quietly unravel. The shift is steady, and it has been building for years. Major carriers have restricted new policies in exposed areas over recent years. Rates climbing far ahead of wages and inflation. Non-renewals rising year over year across multiple regions. Options narrowing in regions that appear stable on the surface. Catastrophe payouts crossed hundreds of billions in recent seasons. Rebuild expenses escalated due to supply chain issues and labor shortages. Reinsurance rates elevated globally, passing costs downstream. The equation stopped balancing for many providers. They reduce risk selectively. Homeowners absorb the impact gradually, or search for scarce alternatives that often come with higher deductibles. The trend persists into 2026. Availability continues to tighten. The figures stand out clearly and consistently. Typical annual costs now top $6,000 in the most affected states for standard coverage. Increases sharpest where repeated severe weather hits hardest. Hail events causing widespread damage. Hurricanes displacing communities. Wildfires consuming vast areas. Convective outbreaks delivering sudden losses. Season after season without pause. Payouts compounding year by year. Portfolios pressured from all sides. Policies restricted in targeted zones. Gradually at first. Deliberately now. But gaining speed as data accumulates. Nationwide averages rose over 20% in recent periods. Some areas seeing double that. Non-renewal rates climbed in 46 states recently, highest in coastal and plains regions. Why these states specifically? The factors accumulate over time, layer by layer. None of this arrives overnight or without warning. First, escalating severe weather frequency. More intense events annually across the map. Insured losses growing steadily and predictably. Second, inflated reconstruction expenses. Materials and labor costs surged post-pandemic. Settlements far higher than historical norms. Third, reinsurance market tightening worldwide. Global pressures flowing downstream to local carriers. Providers safeguarding reserves against future claims. Fourth, concentrated regional hazards building up. Hail across the plains in spring storms. Hurricanes along coasts in summer cycles. Wildfires in western zones during dry seasons. Each prompting focused withdrawals and adjustments. Fifth, differing state regulations playing a role. Some approvals lag behind needed rate adjustments. Risk accumulates until thresholds trigger major changes. Sixth, mounting household affordability strains overall. Additional expenses pushing family budgets to limits. One more cost tipping the scale for relocation decisions. This is where explanations often end, and where the deeper effects begin to unfold. Remember the non-renewal letter? This is where it starts reshaping households and blocks over months. No coverage blocks conventional financing entirely. Lenders require protection as a standard condition. Sales compelled when alternatives fail. Values ease in impacted zones gradually. Purchasers pause amid uncertainty. Listings accumulate on the market. Households depart seeking stability. Demographics thinning silently across age groups. Younger cohorts reassess commitments long-term. Tax revenues moderate as property growth slows. Municipal resources stretched longer-term with deferred maintenance. The cycle feeds forward subtly. Quiet early stages. Clearer later as it compounds. Here are the 10 states hardest hit right now. Counting down from 10. Building tension toward the one undergoing the sharpest adjustment. each revealing another layer of the pattern. Colorado wildfires and hail pushing rapid rises across the state. Average premiums over $4,000 annually. Increases up to 27% in recent years. Major carriers like State Farm limiting new policies in wildfire-prone areas. Non-renewals affecting thousands in mountain and plains regions. Homeowners facing higher deductibles or state-backed options. Texas hail, hurricanes, and severe storms compounding exposure. Average costs close to $4,000 yearly. Rates up over 20% recently. Insurers like Allstate and farmers managing risk carefully in coastal and central zones. Non-renewals rising in hail corridors. Families reconsidering long-term stays amid affordability pressures. Kansas intense hail and tornado threats dominating the landscape. Premiums ranking near the top nationally at over $4,000. Steady climbs year over year. Carriers pulling back in tornado alley sections. Non-renewal rates elevated in rural and suburban counties. Property values softening where coverage gaps widen. Arkansas, growing storm intensity from convective events. Rates accelerating quickly to nearly 4,000 average. Increases outpacing national trends. Insurers adjusting exposure in flood and storm-prone areas. Non-renewals impacting central and eastern regions. Communities adapting with resilience measures slowly. Oklahoma heart of tornado activity with hail and wind risks. Persistently high expenses averaging over $4,500. Among the most expensive consistently. Major providers trimming policies in high-risk zones. Non-renewal surges in recent seasons. Demographic shifts accelerating as costs mount. California wildfires prompting widespread restrictions statewide. Availability the core issue despite averages around 2,000. But non-renewals in the tens of thousands. State Farm, Allstate, and farmers halting new policies in fire zones. Homeowners turning to the FAIR plan as a last resort. Neighborhoods in Sierra and coastal areas thinning quietly. North Carolina coastal and interior risks layering with hurricanes and storms. Consistent upward pressure on rates nearing 3,000. Non-renewal rates among the highest nationally. Carriers like Progressive reducing exposure in eastern counties. Inland areas seeing secondary impacts from migration. Values holding but under strain. Louisiana, repeated hurricane impacts battering the coast. Availability contracting sharply with averages over 4,000. Projected increases up to 27%. Multiple insurers exiting or limiting exposure in southern parishes. Non-renewals leading the nation in several metrics. Rebuild cycles extending longer after each major event. Florida hurricanes and claims history driving the crisis. Highest averages across key measures at over 4,400. Non-renewals surging dramatically. Farmers, Progressive, and AAA pulling out or reducing exposure. Litigation adding further pressure on carriers. Millions of policies shifted to citizens as fallback. Nebraska hail and severe storms leading the recalibration. Top average premiums countrywide near $5,000 annually. Increases exceeding 20% in hail-heavy seasons. Carriers managing exposure in central and eastern zones. Non-renewals rising steadily year after year. The quiet frontrunner in this shift. The one revealing the pattern most plainly. Where owners confront it soonest and strongest. Entire counties adapting to higher costs. This gradual shift is not fixed everywhere. Not every state follows the identical path without intervention. Some respond ahead with proactive steps, hardening structures against known risks, modernizing building standards statewide, encouraging resilience through incentives and programs, attracting providers again with balanced regulation. Others monitor the buildup passively, await stronger indicators before acting, permit erosion to continue unchecked. The question is not whether this pattern holds. The figures verify it reliably across sources. The question is which areas recognize it early, adapt deliberately, with foresight, because the ones that spot this first won't be the ones quietly losing coverage later.